What's going on, money lovers? Welcome back. So today we're going to be talking about a company that's one of my favorite REITs. I did make a video on it a while back comparing it to Realty Income, the monthly dividend company. And the company today we're going to be talking about is Riocan, which is very similar to Realty Income in a lot of ways. But of the two, if I had to pick one, I would prefer to own Riocan over Realty Income. And we're going to talk about why. Now, real quick, we'll go over some quick highlights about Riocan, look at their dividend yield, and then we're going to look at their investor presentation and whether I think the stock is a buy. So Riocan, as you can see, over the past year is up almost 67%. So REITs behaving like growth stocks, crazy times we're living in. And there are two tickers for Riocan. So this is the United States ticker. It's a Canadian company, so Canada-based, which I also like. Gives me some exposure outside of the US. And it is a real estate investment trust. So there's another great way if you don't own real estate and you would like to get some exposure to real estate. I'm a big fan of REITs. It's an alternative to investing in real estate, and it can just help you diversify your portfolio. So we'll focus on the American ticker for today. If you're in Canada, the ticker is REI.UN. So as you can see, they have a 4.3% dividend yield, 76 cents. Now this dividend is paid monthly. So you divide this number by 12, you get your monthly payout. So if income's your thing, this is the company for you. Expect those dividend checks monthly. Now the dividend yield used to be much higher. It actually, in the pandemic, was double and more. There was a point where it was up to 10%. Because of where the stock was at, but they cut the dividend a little bit because they are focusing on some exciting new projects and to put that money back toward growth. So what you lost in a little bit of that dividend yield, they still pay a solid yield, and now they're going to make up for it in these potential growth prospects. As you can see, if we go back to prior to the pandemic, Riocan was trading at around $20. So you could make the argument that it's still about 15% undervalued. And because of what's gone on in the pandemic, they've decided to go in a new direction, and they're focusing more on residential properties now and mixed use properties. So we're going to look at all those. And that's what I like about this company that's better than Realty Income. Realty Income is all retail companies. And about 85% of their portfolio is made up of retail companies like your Walgreens, gyms, movie theaters, pharmacies, things of that nature. And I don't know that these businesses are going to be the same moving forward. Their days may be numbered. So it is a little worrisome for me owning Realty Income and knowing that there's just so much exposure to retail, whereas Riocan is starting to diversify away from that. So let's take a look at their website here. So they manage and develop retail-focused and increasingly mixed-use properties in Canada's major markets. So they're in key locations in Canada, a lot in the Toronto area. And these mixed-use properties are basically, you have shops in like a mall kind of thing on the bottom floor, and then condos, apartments above them. So that's where they get the mixed-use property title from. They have a long track record here, been around for over 30 years. Don't forget to leave a comment down below and let me know what you think of Riocan or what other companies you want to see me cover in the future. Also, if you're enjoying the video so far, please don't forget to like and subscribe. So we look at their investor presentation here. They reported Q2 earnings the beginning of August. They have 199 income producing properties in Canada, and 96.1% of them have remained occupied throughout this global pandemic we faced. At the peak of the pandemic, I believe their rent collection was down to about 84%, which is still pretty great when you think about it. When all these shops were closed, they were still collecting 84% of their rent. So it just shows how resilient this company is. Most of their properties located in Canada's most in-demand and growing markets. They have a diversified and defensive tenant mix, as was clearly demonstrated throughout the pandemic. They were able to keep paying the dividend and collect the majority of their rent. They're pretty consistent. They're collecting 94% and above of their rent over the past year. They have a strong base here, strong and stable tenants that make up 79% of their rent collection. And these strong tenants are classified as either national office and essential, necessity, value, and specialty retail tenants with strong rent paying ability, and that also includes their residential tenants. Only 21% of their portfolio is potentially vulnerable tenants that have been significantly impacted by the pandemic and or were of concern even prior to the pandemic. So they are shifting away from those. It's good to see here, and we'll take a look at their mixed-use properties. So they have very good retention ratios, and as you can see, it went up year over year. It's at 90, let's call it 91% for Q2 2021 retained tenants. We've seen positive trends in occupancy. Their income has remained steady and near 100%. As you can see here, the markets they're locating in, housing demand is outstripping supply in these major markets, particularly Toronto and Vancouver. There's a great demand for residential real estate thanks to a growing population, more immigration. So their locations are, prime real estate, community centers focused on convenience, necessity, service, and value. And as you can see here, Toronto is growing very quickly. And as you can see, if we compare their office vacancy to some of these other major cities, they have the lowest percentage of vacant offices. Toronto coming in at 9.1% compared to New York, 12%, Chicago, 18%, LA, San Francisco, DC, all around 18%. And the population is growing compared to all these other cities. So 1.6% is the 5-year expected average annual growth. Whereas you look at these other major cities in the US, many of these populations are declining or barely growing at all. As you can see here where Riocan's located, they're in these in-demand, densely populated areas, Vancouver, Montreal, Toronto. Toronto makes up 50% of their total assets, so they are highly concentrated. Now they do still have 91% exposure retail, so a high percentage of their tenants are in retail. I would like to see the residential rentals increase, which I think they will continue to, but that's only 1.3% of their properties right now. Office makes up 7.4%. But as we saw, a lot of this retail, a lot of these retail tenants are highly resilient. If they survive the pandemic, they can survive anything. Here's a good look at their tenant mix. So groceries making up almost 17%. Grocery, pharmacy, and liquor stores. Movie theaters are only 4%, which is significantly lower than Realty Income's exposure to movie theaters. Value retailers, 14%. So they're very well diversified. So here, this gives you a little idea of what their mixed-use properties look like. So these developments are increasingly expanding their exposure to office and residential properties. When you think about it, convenience is key. Everyone wants what's most convenient. So if you can work close to where you live and shop right where you live, this is going to be highly appealing, especially when you're in these highly sought after areas like Toronto. And if you're familiar with Canada and Toronto, you can see where where many of their properties are located. Some are still under construction, some plans for future development. So they're located along key points in Toronto's transportation system. So again, going back to their focus on convenience, highly desirable areas. And here's a look at some of their residential mixed-use properties. So as you can see, they're almost entirely leased out already, 88% leased. And this East Central in Toronto, 97% leased for this second property here, and so on and so forth. Here's some of their other residential exposure. They've got exposure to townhomes and condominiums. And many of these units are sold out and even pre-sold. 99% of these condominiums at 11YV are pre-sold. That just goes to show you how much demand there is for these properties. Here's a little timeline for many of their properties they're planning to develop in 2021 and beyond. As you can see here, they have a healthy balance sheet. Their debt is around 44.7% of their total assets in Q2, and their goal is to trim that down even further to 38 to 42%, and their funds from operation payout ratio, how they pay the dividend here, is just under 80%, which is down from Q1 where it was 90%. So they have room to grow the dividend. They have excess capital on hand, and they've got lots of projects underway. They have 60 projects in their total development pipeline, the majority of which are residential. Over 30,000 are residential rental properties out of a total of 40,000. So I think these mixed-use properties make a lot of sense. This is just convenience. You sleep, you work, you eat. You can do everything in a Riocan property located where everything is convenient. I think these properties seem to be highly appealing. If you're from the Canada or Toronto area and you've seen these properties or have any experiences to add, let us know in the comments below. So all in all, I think Riocan is a great REIT to own. I own 3 REITs, Riocan, Realty Income, and Stag Industrial. And of the 3, I would say Riocan is the most diversified. And I would like to see them continue, which it seems that they are, moving toward these residential or multi-use properties. And I think the future of Riocan is a bright one. So if you want a consistent, solid, dividend-paying REIT that pays monthly, this could be the company for you. And again, there should be some upside here as they haven't completely recovered from their pre-pandemic levels. And they're building out all these incredible residential and mixed-use properties. So that should only help them continue to expand and prosper. So if you enjoyed the video today, please don't forget to like, subscribe, leave a comment below, and let me know what your thoughts are on Riocan. What companies do you want me to research in the future? This is Vinny from the Investment Club, and I'll see you next time.